Welcome to our quarterly bulletin. My name is Metula Sikakana and I am the Business Development Manager at Equilibrium Investment Management. Just some housekeeping. We applied for Continuous Professional Development or CPD points. It's important to please watch the full session and add your ID to the CPD section so we can verify your attendance. You may also view this event on this platform at any time until the end of Feb and receive your CPD points. Our operations team will email you your CPD certificates to you during March 2024. Please also feel free to ask questions in the Q&A section, and our speakers will either answer them live or get back to you after the event. You will also find more information about our speakers under the Speaker tab on the top menu bar, or if you scroll down and you can download the PDF presentation. Okay, let's kick off the session. First is our economist, Sanisha Packirisamy, who will discuss the 10 macro trends worth watching in 2024. Thank you for joining us today, Sanisha. Please take it away.
Thank you, Metula. Hello, everyone, and thank you for joining us again. Investors grappled with an unusually difficult time in financial markets last year. Initially, there was a widespread belief that a surge in interest rates over the course of the prior 2 years would trigger recessions globally in 2023. But this expectation turned out to be wrong. In January of last year, the Wall Street Journal consulted a panel of 70 economists to gauge the likelihood of a recession in the upcoming year. The average estimate stood at 63% a year ago, but it has since dwindled to 39%. Contrary to earlier predictions, economic growth surged throughout 2023, maintaining a robust pace. Despite concerns about too high inflation and the consequent interest rate hikes designed to quell these price pressures, consumers surprisingly increased their spending rather than cutting back on it. Households were supported by pandemic savings and a robust jobs market, with unemployment remaining at historically low levels. Additionally, the initial assumption that rising interest rates might lead heavily indebted borrowers to struggle with their obligations also proved to be less impactful on the economy than initially anticipated. This can largely be attributed to 3 key factors, including a higher services component of the United States economy than what was the case historically, the availability of a wider range of instruments to hedge interest rate risk, and a larger proportion of fixed-rate mortgages, which locked in households at more favorable rates than where they are currently today. While there is a shared belief among investors that a severe and prolonged recession is likely to be averted this year, there is an expectation of a slowdown in global economic activity. This deceleration is anticipated due to the delayed impact of previous aggressive monetary policy tightening, constrained fiscal flexibility, and higher than targeted inflation. Moreover, unforeseen geopolitical events are poised to continue as unpredictable variables, influencing the political, economic, and financial landscapes in 2024. In today's session, we will delve into 10 pivotal trends within our macroeconomic purview for the current year. Topping the 10 trends on our macro radar is the expected shift in the trajectory for economic growth. We raise the question of whether economic resilience will prevail or whether the impending gravity of previous monetary policy actions will act as a negating factor in 2024 for what has so far been relatively strong growth. Despite ongoing conflicts such as the Russia-Ukraine and Israel-Palestine wars, the global economy displayed resilience over the course of last year. Initial concerns about an imminent recession due to a sharp rise in interest rates to curb inflation were proven overly pessimistic. Inflation is receding globally, unemployment rates have generally stabilized at low levels, and major central banks have paused tightening measures and even hinted at the next leg down in monetary policy. Nevertheless, the foundation of this economic resilience appears a bit fragile. The potential lagged effect of higher interest rates and increasing corporate bankruptcies, particularly in the US and Europe, poses risks to economic stability in the year ahead. Moreover, growth in the world's second largest economy, China, looks wobbly after previous stimulus injections failed to offset the slump in the property sector. Authorities in Beijing did nevertheless back-end load support measures late in 2023, and these should start to deliver enough support to sustain growth levels in China at somewhere between 4.5% and 5% for this year. Our second key macro trend focuses on the shift from synchronized global economic activity in a post-pandemic world to varied trajectories in economic growth across the world as policy reactions start to shift. Although the international economy has defied expectations with its resilience last year, the International Monetary Fund, or the IMF, estimates that global output remains almost 3.5% smaller than if the pandemic had not happened at all. Varied fiscal and monetary policy responses led to differential economic outcomes across the globe. These disparities in growth outcomes are likely to persist, with advanced economies benefiting from an earlier post-pandemic reopening, the availability of more effective vaccines, robust stimulus measures, and a quicker labor market recovery. In contrast, low-income and developing economies face larger output losses due to higher interest rates, depreciated currencies, and lagged inflationary pressures. Consumer spending strength in the US is anticipated to decelerate throughout this year due to the gradual depletion of pandemic-related savings, coupled with a less supportive labor market, particularly as the demand for labor dips. What's more, the lagged effect of tighter interest rate policy is now negatively affecting fixed investment intentions. Across the Atlantic, the slowing of the Franco-German growth engine will constrain economic prospects for Europe. Given the quantum of public debt incurred during the pandemic and then again during the war in Ukraine, the ability of governments in Europe to stabilize the economy through increased fiscal spending is starting to diminish. This is particularly true for heavily indebted nations. In addition, pressure on real wages and ongoing geopolitical conflict point to further growth headwinds for the region. Despite earlier criticism from investors regarding China's restrained fiscal and monetary policies in 2023, substantial policy announcements made later in last year are now poised to have positive effects on growth this year. These measures are expected to stabilize the housing market as well as enhance consumer sentiment. Nevertheless, Chinese authorities' dedicated focus on higher quality and more sustainable growth suggests a lower growth channel from here. Across the globe, the combined impact of the pandemic, the conflict in Ukraine, and escalating climate crises have reversed the long-standing trends in poverty reduction. This has led to an increased gap between the wealthier and less affluent nations. Constrained fiscal space and heightened debt vulnerabilities in certain regions have set back the convergence of poorer nations towards the living standards of the higher income economies. Our third trend to watch focuses on the drop-off in inflation and the pace of deceleration it will assume this year after surprising most investors positively in 2023. The Bank for International Settlements notes that wringing the last bit of excess inflation out of the economy takes longer than those initial phases of reducing inflation. Global inflation has already more than halved from its peak in 2022, but challenges persist. The IMF warns that inflation in most inflation-targeting countries exceeded central bank targets last year, and it expects this to continue for this year. Only by 2025 is headline inflation anticipated to be close to target in the majority of the world's economies. This next phase of decelerating inflation is expected to take longer due to various factors, including waning food and energy-based effects, geopolitical strife affecting global supply chains, potential demand pickup as real wages recover, and political pressures to ease policy in a slowing economy. With the market currently pricing in what we view as an overly aggressive 6 interest rate hikes for this year in the US economy, we would also like to highlight the potential risk of the Federal Reserve making a policy error and stirring up inflationary pressures further down the line. Our fourth trend to watch highlights the importance of collaborative efforts between monetary and fiscal policymakers. Monetary and fiscal policies as essential economic functions are closely intertwined. The pandemic demonstrated the two need to be well coordinated, and it taught us lessons about when these policies work against each other. Although fiscal support can buffer an economy during a downturn when inflation is high and persistent, fiscal support across the board may actually seem imprudent. This would force central banks to hit the brakes even harder to maintain price stability. Fiscal responsibility through credible frameworks is crucial to address debt sustainability concerns. This can be done by rebuilding buffers that can be deployed in the event of the next economic shock. This won't, however, be an easy task in the years to come, given the structural shifts of an aging population, the move to net zero carbon emissions, and increased defense spending amid rising geopolitical tensions. The world economy was a complicated place even before the tragic events unfolded in the Middle East. However, the conflict between Hamas and Israel has introduced a new layer of uncertainty. Airstrikes launched by the US and UK in Yemen in response to attacks by Houthi militants have seen tensions rising in the Red Sea, placing restrictions on global trade once again and forcing nations to reroute cargo. Global political tensions are expected to remain heightened in the coming quarters, with a significant number of elections worldwide in 2024. The Economist suggests that over half of the global population, that is 76 countries, is set to undergo elections this year. The Democracy Index from the Economist Intelligence Unit anticipates that only just over half of the countries it covers will witness entirely free and fair voting processes. This is suggestive of global economic power increasingly shifting toward autocratic rule. While voters in the US represent only a small share of the global economy, the US election outcome will be pivotal for all from an economic and a security standpoint. The Republican frontrunner and former President Donald Trump has garnered a substantial lead over incumbent President Joe Biden in several swing states where polls have been conducted, suggesting the potential for a second presidential term for Trump. In this scenario, we anticipate an increase in economic nationalism with a rise in trade barriers. The US would also likely withdraw from an active role in global affairs. Additionally, under a second Trump term, there may be a rollback of regulations, heightened scrutiny on fiscal sustainability, and increased attention on central bank independence. This outcome would also leave the Ukrainian population in a more uncertain situation, as the extent of military assistance gets scaled back. South Africa will also make its mark on the busy political calendar this year. Our sixth trend to take note of focuses on SA's political future. A decline in voter participation and significant gains for fringe political entities at both extremes of the voter base may be indicative of SA's evolving democracy. Yet, these trends could also, more worryingly, signify a more fractured society. The ruling African National Congress, or ANC, continues to govern with a reduced majority, but this majority is likely to be challenged in the foreseeable future. The ANC's support has waned due to the energy crisis, logistical breakdowns, and its failure in making enough progress on tackling corruption. The National Prosecuting Authority's inability to prosecute influential figures linked to state capture further hampers SA's chances of being removed from the grey list by 2025. On a provincial level, the potential for a coalition-led government looms larger, especially in Gauteng and KwaZulu-Natal, which collectively constitute 44% of SA's population and 49% of SA's GDP. Potential scenarios for national election outcomes range from an ANC-led coalition or a marginal ANC majority, suggesting a less stable political environment, all the way to a retained ANC majority with a firmer mandate. In the latter case, a more stable policy environment could emerge if the ANC and the incumbent president pursue their agenda more assertively. However, polls suggest that the probability of a retained ANC majority is dropping. While load shedding is still expected to detract from SA's economic growth in 2024, improvements in Eskom's generation plan and increased private sector investment in renewable energy suggest a potential easing of the energy crisis. Lower anticipated levels of load shedding could translate into a smaller 0.8 percentage point detraction from GDP growth in 2024 relative to the 2 percentage points estimated by the South African Reserve Bank, or SARB, for last year. While the energy crisis begins to taper off, logistical challenges, particularly in rail and ports, are likely to take its place and features as our seventh trend to watch this year. Rail inefficiencies alone are estimated to have cost the economy around 5.5% of GDP last year. Despite government initiatives to address these logistical issues, and this includes the implementation of the Freight Logistics Roadmap, growth projections for 2024 and 2025 are likely to be constrained to 1% for this year and 1.7% in next year in our view. Coming in at number 8 is SA's worsening fiscal conditions. SA's interest burden has surged, with warnings from the IMF that it could reach 27% of fiscal revenues by 2028. Balancing spending reductions, tax increases, and managing state-owned entity challenges will be critical for fiscal consolidation. Although government proposed to plug the financing gap in the current fiscal year without having to raise government bond issuance by much, pressure on SA's local market will escalate in the coming quarters as SA's redemption profile ramps up. Swift and effective monetary policy actions, coupled with clear central bank communication, averted a prolonged divergence in inflation expectations in SA. While acknowledging potential inflation risk from geopolitical factors, currency fluctuations, and administered prices, we anticipate that demand-driven and wage-related inflation will remain contained in our 9th theme, depicting a breather from inflationary struggles. Our projection sees headline inflation averaging at 5.4% in 2024, decreasing to an average of 4.5% by next year. Finally, in our 10th trend, we caution against the likelihood of continued central bank caution in spite of falling inflation and the expectation of steady to falling rates. While there has been a positive shift in inflation drivers, concerns linger over currency weakness and geopolitical factors affecting global food and oil prices, which typically have a larger effect on lower income households which spend more of their wallet on food and rely more on public transport. We expect the first interest rate cut of 25 basis points by the second quarter of this year and estimate that we get 3 cuts in total for the year. Serving as navigational aids for the year ahead, these trends are poised to shape the fate of global politics, economics, and financial markets in the coming months. Even though investors are pricing in closer to a smoother landing, 2024 could still present a challenge to investors as we navigate a world of fragmented economic growth and higher volatility risk stemming from increased geopolitical tensions. I thank you for your time.
Thanks for sharing such great insights, Sanisha. Next, we've got Rupert Giessing, a client fund manager in Equilibrium, who will discuss how our local models have performed. Pleasure to have you join us today, Rupert.
Thank you, Metula. After a brutal 2022, investors went into 2023 worried about persistent inflation and expecting a recession by the second half of the year. And who remembers the first quarter regional banking crisis, which sparked fears of a credit crunch? Instead, inflation has cooled and economies have remained solid. And for most investors, the final quarter of 2023 marked a much-needed comeback when it came to both equity and bond market performance. US Treasury Secretary Janet Yellen recently said in an interview that a soft landing in the US economy was now underway, after solid December job growth data and consumer spending patterns suggested confidence in the economy. But many uncertainties remain and market fragility is still prevalent. Debates will likely be focused on whether global economies will continue to avoid recession, whether inflation will stay on its moderating path, and if the Fed will cut rates as aggressively as investors currently expect. Add in ongoing conflicts and geopolitical tensions, as well as a calendar filled with elections, and 2024 promises to be another volatile year for financial markets. So, how did it play out during the last quarter of 2023? The increased optimism for a Federal Reserve rate cut in 2024 was the main proponent of the positive trend in December, which seemed only fitting in a year where market dynamics were often influenced by investor sentiment. Global equity was the best performing asset class in 2023, with the MSCI All Country World Index, or ACWI for short, returning 31.3% in rands for the year, after adding 7.8% over the quarter. The performance should, however, be seen in the context of how it was generated. Most of this has been driven by the so-called Magnificent Seven, which includes the likes of Apple, Microsoft, Alphabet or Google, Tesla, Amazon, Nvidia, and Meta or Facebook. Of course, most of these names have been closely linked to the hype surrounding artificial intelligence and the narrative that it will change life as we know it. Collectively worth more than $10 trillion US, those 7 shares alone are equal to roughly double the size of the entire stock markets of South Africa, India, Brazil, and Russia combined. Part of the sheer magnitude has been the share price performance this year. Up by 74%, these stocks contributed 39.8% of the total index return for the year. It makes the solid return of 12% for the rest of the world's companies seem fairly pedestrian in comparison. As impressive as the Magnificent Seven returns were, it should be seen in the context of the inherent risks of such high valuations and market concentration, as there are nearly 3,000 shares in the MSCI ACWI. Emerging markets lagged their developed market counterparts with a 3.9% return in dollars, which brought emerging markets' yearly performance to 9.8% in USD. Overall, emerging markets lagged developed markets by more than 10% for the year. Another key theme in 2023 was the disappointing growth data and negative news surrounding regulations in China. This weighed heavily on emerging market equities, which underperformed developed markets for over the year. The ACWI Emerging Markets Index returned 4.7% for the quarter and 18% for the year. As evidenced throughout the year, the local equity market was largely influenced by global factors, which helped to improve investor sentiment that translated into strong year-end performance. This was supported by a favorable November inflation print, which brought the local market up 8.2% for the quarter to bring the year's performance to 7.9%. However, local equity returns continue to be impacted by the negative sentiment surrounding deratings, which is especially evident in the mid and small cap sector. A meaningful improvement in load shedding and more growth-friendly policies are required to improve general sentiment for the asset class. The best performing sectors were financials and industrials, returning 21.8% and 16.6% respectively for the year, while resource shares ended the year 11.8% lower. Global bond markets had to navigate contradicting US monetary and fiscal policies, which led to increased volatility in the asset class. The US 10-year Treasury yield peaked at over 5% for the first time since 2007, as markets priced in stronger than expected US growth, as well as fiscal concerns before the strong rally to finish the year. The World Government Bond Index returned 4.9% and 13.1% in rands for the quarter and the year, respectively. Local fixed income assets were under pressure for most of the year on the back of local fiscal concerns and political risks before global factors underpinned the year-end rally. The yield curve remains steep and offers attractive real yields in an easing inflationary environment, but fundamental risks remain. The All Bond Index, or ALBI, returned 9.7% for the year after adding 8.1% over the last quarter. The interest rate sensitive local and global listed property sectors responded positively to the interest rate cuts priced in by the market, which then reduced the refinance risk faced by this sector. South African listed property added 16.4% over the last quarter to finish the year as the best performing local asset class with a 10.2% return, while global property returned 19.2% for the year. This is a reminder of the importance of portfolio diversification with appropriate exposure to all asset classes, even if the ride can sometimes be a little bit bumpy over the short term. Possible interest rate cuts will impact the return prospects for local cash, which currently offers decent real returns as evident in the 2.7% return by Steffi over the last quarter to finish the year on 8.06%. Although the rand had a strong month during December, strengthening by 2.6% against the greenback, the local currency ended the year 8.1% weaker at 18.56 rand to the dollar. From a portfolio perspective, what is worth noting is how quickly things can change. Quarter 3 of 2023 was a tough quarter for financial markets, and our multi-asset solutions delivered associated returns. Fast forward back to quarter 4, and as mentioned earlier, due to the remarkable rebound in growth asset classes, the multi-asset portfolios were ahead of their respective CPI plus benchmarks and peer groups during the quarter. This illustrates the importance of staying invested for a minimum of the recommended time horizon of the portfolios in order to maximize the probability of getting to the return objectives of the solutions. The income portfolio delivered 3.3% in the quarter, while the conservative, stable, moderate, balanced, growth, and unconstrained growth portfolios delivered 6.5%, 7%, 7.3%, 7.7%, 8%, and 8.1% respectively. The income portfolio delivered stellar performance relative to the Steffi benchmark, while also ending the year outperforming the peer group over the 12-month investment horizon with a return of 9.6%. So, what were the key drivers of performance in our portfolios? We will use the Equilibrium Balanced Fund as a proxy for our fund performance overview. The attribution table indicates that performance was mainly driven by our strategic asset allocation, while tactical asset allocation and manager selection detracted slightly from performance. Pleasingly, the portfolio outperformed both the CPI plus 5% benchmark and the peer group over the past year. In comparison to our long-term expected returns, which is in the black bars, most asset classes performed fairly over the last 12 months, barring SA equity, which underperformed, and global equity, which outperformed respectively, as discussed earlier. Tactical asset allocation speaks to how we underweight, overweight, or take neutral positions on asset classes depending on our short to medium-term views. The underweight position in global equity was the largest detractor from the performance, as we were underweight in an asset class that performed relatively well. A noteworthy contributor to performance was our underweight position in global property. Now, let's evaluate how our investment manager selection has fared. Similarly to what we saw in quarter 3 of last year, for its underweight exposures to consumer discretionary and precious metals contributed positively to performance, as these sectors were hard hit during the quarter. Momentum core equity, which is our smart beta capability, detracted from performance, mainly due to the momentum or trending factor that came under pressure towards the end of the year. You will recall that the fund is well diversified across the different styles of equity investing, including value, quality, and trending or momentum. As I mentioned earlier, we make tactical asset allocation calls on short and medium-term asset class views. From the third to the fourth quarter of last year, we made changes to our positioning in SA bonds. Locally, we changed our views on bonds from overweight to neutral. Although yields on SA bonds remain attractive, a significant portion of the upside was captured towards the end of last year. Coming into 2024, we are cautious with the upcoming national elections and continued market uncertainty and global monetary policy decisions. Although the macroeconomic backdrop for South Africa is not favorable, South African equity displays attractive valuations, and we therefore retain our neutral to overweight position to the asset class. As the best performing asset class in South Africa last year, market participants are bullish about the prospects for South African listed property due to the anticipated interest rate cuts later in the year. However, we have some concerns, including the oversupply of office space and limited diversification possibilities locally. Therefore, we retain a neutral position to SA property. Globally, cash is showing attractive yields while bonds are pricing in a recession. We've maintained neutral positions to these two asset classes. Global equity remains a valuation story, and despite some market participants anticipating a strong economic recovery, there are still some fears of a recession looming and uncertainty related to geopolitical tensions. We therefore retain an underweight to neutral tactical position. We are also neutral on global property. Although the opportunity set is much more diverse in comparison to local property, growth asset classes are risky during periods of market volatility. Thank you.
Thank you, Rupert. And now, Richard Stutley from our London office, who will be discussing our global models and opportunities in the global environment. Welcome, Richard.
Thank you, Metula. Right, next, let's go on and talk about returns of the global portfolios. Everything I'm going to talk about is in dollar terms. I'm sure you'll be aware that if you take the dollar rand exchange rate, you can then add about 8% to returns for 2013. So a nice additional kicker. Okay, on my second slide here, we've got the portfolios. You should be familiar with these: cautious profile, a managed profile, a growth profile. The way I always like to think about this is if you have, or you're talking to someone who's got a 3-year time horizon, then obviously start thinking about the bottom left of this chart. If you, as I say, you've got 3 years to invest, you want hopefully quite consistent returns, something you can reasonably rely on. It's not guaranteed, but you know, it's got a pretty decent chance of achieving it. Then that is the kind of asset allocation mix that you should be looking about. Yes, it's got lower attendant returns, but as I say, you should more consistently get those returns. And then, as you know, suddenly you're speaking to someone, they've got 7 years to invest their money. Well, let's put more of it to work in equities and start thinking about the growth profile on the right-hand side. So anyway, those are the models. You should be familiar. Any questions, always get in touch. This then I would consider kind of long-term proof of concept. Have each of the models delivered on the return expectations we set? And anyway, you'll be looking at the solid line. We've got kind of a green here and then a dark blue and a red, and just comparing those against the dotted line of the same color. Pretty straightforward. Obviously everything rising from bottom left to top right, that is us making positive returns. And yes, the solid lines are ahead of those dotted lines. So can we deliver on the types of returns we've stated? Yes, we can. There is the data. I always make this point, so apologies for anyone who listens regularly to these videos, but you know, the question you should be asking yourself, I'm sure you are they reasonable? Targets we've set, you know, are we setting a reasonably difficult and worthwhile benchmark? I think they are. You be the judge of that. But margins in excess of cash of 2.5%, then 4%, and then in fact 5.5% above cash per annum. I think those are pretty good added returns, and does demonstrate that you're doing more with investors' capital than just leaving it in the bank over time. So that's the long-term returns. Next up, this is summarizing 2023, and I'm sure you saw it. I'm sure you're feeling better as a result. We had a classic Santa rally, so markets very strong into the end of the year. What is this chart picking up? Well, each column you'll see on the x-axis, that is an asset class. We've got world equities on the left, and all the way over on the right we've got commodities, and the column is picking up the highs and lows through the year of those asset classes. So actually DM equities only went one way, they were always positive. But if you take something like global bonds, well, at times they were down nearly 5%. That's the fourth column you can see there. At other times they were up of the order of 5%. And anyway, the little bar you can pick up, that tells you where we ended up for the year. And as the title of the chart says, in pretty much all asset classes, we ended the year towards the top of their range. So there's your Santa rally, rallying into the end of the year and ending at the highs. Pretty decent returns across the boards, clearly led by equities, another very strong year for equities. DM equities, quite considerably ahead of emerging market equities, which is the third column you can see there. Powering that return of DM equities was the US. If you just go right over to the right-hand side, commodities, I think, of some interest because, of course, in 2022, commodities doing really well. Your classic kind of short-term extrapolation of that is to say 2023, load up my portfolio with commodities, please. Well, if you'd done that, you would have managed to lose money in a year when basically everything went up. So anyway, it's one data point, but it's just a cautionary tale about extrapolating returns from a single year, take it 2022. So that's the year 2023, decent returns. I said at the outset, you can add a bit if you're thinking in Rand terms for Rand depreciation. What happened then, because this is a quarterly video, so what happened in the fourth quarter, you asked me. The key thing that was significant is you've got the world's most important central bank, the Federal Reserve in the United States. They come out and they acknowledge that yes, the world is looking a bit more understandable and less concerning and less uncertain than at the start of 2023. And so what did they do expressly? They came out and said, we think inflation is moving the right way. That's great news. And therefore, we should, at some point in 2024, be able to start bringing down interest rates. And what you had on the back of that was a big rally in bond yields. That means bond yields actually came down. So you can see all of the lines here. You've got in red, you've got what is the yield on 2-year treasuries. That's coming down. In dark blue, you've got the 10-year yield, which most people anchor to. I often think in terms of the yield on the US 10-year, and that came down as well. The most important line, however, to look at is actually at the bottom, which is the light blue line. That is the 10-year real yield. Remember, what is a real yield? A real yield is we're going to pay you this even after inflation. So if inflation is 10%, we're going to add on that 10% to your returns such that you get that stated yield in the region of 1.5 to 2.5. You're going to get that even after taking into account the effects of inflation. So movements in that real yield is what ultimately drives asset prices. We saw that in 2022, very painful. In Q4 last year, you see it start to come down, and that means all other yields can come down. And if yields going down, you guessed it, prices are going up. And that is why we had a decent return. Now, I'm going to return to this because one of the things to bear in mind is that I think markets have moved too far and too fast in terms of interpreting that signal from the Fed. Yes, Fed governors came out and said we're going to have some interest rate cuts next year in 2024. They didn't say we're going to have of the order of 150 basis points worth of cuts. That's an extraordinary amount for the market to all of a sudden expect. For that reason, we're a little bit cautious. But anyway, great returns in Q4. You can see that move just quickly in terms of interest rate expectations. You can see that a bit more clearly on this chart here. In yellow, that's where the market thought interest rates were going to be at these points in time going into 24 and the start of 25. All of a sudden, in grey, that's the shift to where we are only a few days before we started recording this video. A big shift. The market thinks interest rates are going to be somewhat lower. Do I agree with the direction that's gone in? Yes, I do. We're positioned for that. I'll touch on that again in a moment. But do I think it's gone too far? Absolutely. That is one of the takeaways from today's video. If we move on here, one of the other big themes from the year is that dispersion in equity markets. I spoke about how well equity markets had done, posting returns upwards of 20%, but you did have to be in the right areas. You've got the US stock market there, dark blue at the, I say it's the US, it's not, it's in fact the world, but it was driven by the US. Anyway, developed markets at the top there, up in excess of 20%. But look what's down at the bottom. China, in many people's eyes, a darling for a number of years. China is going to continue emerging at breakneck speed, and eventually the stock market will come to dominate even the US. Well, that certainly wasn't the case last year. Nonetheless, when we look at that dispersion, i.e. two lines heading in completely different directions, it does start to look attractive to us, and so clearly something we're appraising, whether there are now some interesting opportunities in China. Within that return of developed market equities, the MSCI World, I'm sure you've heard this newly coined phrase, we've got the magnificent 7 stocks, so your Nvidias, your Apples, Amazons, Microsofts, etc. You put those companies together, fantastic cash generative companies with great underlying products. You put them together, they really drove the market. So what this chart picks up, everyone talks about the return, the S&P 500, well that's here in the kind of turquoisey green. Very good year for the S&P 500. But what happens if you strip out just 7 stocks, those magnificent 7 stocks? Well, it has a huge difference, and that leaves you instead with the red line. This was a challenge for active managers, the kind of managers who we are allocating to. Thankfully, we'll see momentarily our returns were still very decent for the year, but this did represent a challenge, and it's another thing alongside what I referred to with bond yields having got ahead of themselves. It's another thing we need to be very mindful of. This doesn't look like a particularly healthy market. This looks instead a bit faddish, as if people are just jumping on the bandwagon of a single idea. Let's just load up on these techie, large US listed companies at the expense of all else. Let's ignore all these other great innovative businesses out there. So this is something for us to be aware of and just to build into our thinking when thinking about where next to allocate. Right, I said the returns, here are those returns, and let's start in one of the leftmost columns, which is thinking about the quarter, obviously. Returns close, well, high single digits, close to double digits, and in fact in double digits for the growth fund. So 8.3%, rising to 9.4% for the managed profile, and then up to 10.3% for growth. So a really good final quarter of the year, and then adding to very decent one-year returns, all of them in double digits and nearly in that 20% range when you look at the growth fund. So very decent absolute returns, thankfully, because we've come off the back of a dreadful 2022, but there's your rebound. That's a classic kind of thing to see when you look at market history. So very decent absolute returns. Equally important to me, I should say, is how we're doing against these key reference rates, which we've also put on the chart. So how are we doing against the targets we've set ourselves? How are we doing against peers? Because obviously that's someone else you could have allocated capital to. And when I look across the numbers, you can do it in your own time as well. Very decent returns pretty much across the board. We've said that the cautious fund should be able to deliver returns over 3-year cycles. What you will know is that over 3 years, that's the weakest period for all of the funds. Why is that? Why have the portfolios done poorly over 3 years? Well, it needs to be seen in a very simple context, and that is that global bonds have done minus 6% per annum over the last 3 years. So that's just a reflection of that tough environment we've been in. It's a big reflection, obviously, on 2022. So that is why returns, not just for the cautious profile, but across the board, are weaker over that 3-year period. That then is the only time period during which we've not managed to meet those global cash plus a margin expectations and targets that we've set. So generally, on the vast majority of occasions, as shown here, we're outperforming the target set. I acknowledge the 3-year, absolutely, that is disappointing for us and for investors. Hopefully with that context of minus 6%, you'll understand that it's been a very tough environment. You can also eyeball the figures, and I think you'll see pretty much without exception, we're ahead of the median manager. I know one instance where we're not, one time period. Vast majority of time, overwhelming majority, we are ahead. Again, I hope that is a positive for you to take away. So those are the returns of the portfolios. We next go in just to look at how each of the underlying managers has done. You can see 3 months, 1 year, all the way out to 5 years. No surprise that over 1 year, that's where you're seeing those really decent returns, particularly from equity managers at the top there. Our DM equity selection comes through the Momentum Global Equity Strategy. It is a multi-manager strategy. All that is doing is giving you access to what we think are the best managers from around the world. And I'll touch a bit more on that in a moment. Anyway, again, it's a 3-month report back on performance. That's what I'm going to focus on. What immediately catches my eye, and I'm sure for you as well, is those great returns coming through from our gold strategy, managed by 91, and indeed much out of favor global real estate catalyst managing that strategy. So each of those up double digits, 16.5% and 15.1% during that quarter. Really decent returns. What happened to gold? I'm sure you know, with the uncertainty emanating from everything that's happening in the Middle East, that's been very beneficial to the gold price. Gold price up, this strategy that invests not only in physical gold, but also in the common equity of gold mining companies. It's done extremely well. It's done extremely well for a protracted period now, and clearly given we've held it, that doesn't necessarily surprise us. We are in a difficult world, one characterized by demographics that are only getting worse, by excessive amounts of debt, by inflation that has been an incredible problem, but nonetheless may be the only solution to some of this debt. So this real conundrum around how we manage things like inflation going forward. Given that uncertainty, to have a good that has absolute demonstrable value, gold can be used commercially, gold clearly can be used in terms of jewelry. It has intrinsic value and nonetheless is divisible, is innately expensive because of its limited supply. It is a great product to have in a portion of your portfolio. We think that's why it's in the models, and those numbers to date back up the allocation. And then just on property, you know it, I'm sure I will have touched on it in recent videos, hugely out of favour. People would say to me, don't invest in property. It's all about an office sector that doesn't exist anymore because we all work from home. Well, of course, our allocation to property doesn't look anything like that. Instead, it's got a very small allocation to office buildings and only very select ones in the best cities where people still tend to go. An allocation of the order of 4%. So, you know, only about 1 in 25 of our buildings is an office building, if you think about it that way. People also say to me, these are companies that are too indebted. Well, I'm sure in previous videos I've shown you the data that shows that actually the type of companies we're allocating to within that property universe are not overly indebted. They're quite prudently managing their debt in the range of about 25% debt to total asset value. Similarly, their debt isn't susceptible immediately to rising interest rates because actually they've locked in, they've fixed out their debt over a number of years, as many as say 5, 6, 7 years into the future. So we were happy holding on to that position, and it's done very well over 3 months and obviously boosted its 1-year return as a result. So those I think are the main ones I'd highlight on this chart here. On the next chart, just breaking down some of the things that really worked and then perhaps didn't work so well during that quarter. What did work? Well, it's the 2 areas I've just touched on. Our allocation to commodities, that was a big plus. Our allocation to real assets in the form of property, that was a real big plus. Particularly, I think a lot of our peers will have packed up and abandoned that area, so we've done well to stay in there. What did less well? The key factors herein were really our holding in cash. We went into the quarter holding a little bit more cash. We thought, you know, at that point of the year, equity is already up 10%. That's a pretty decent return. It serves for us to be a little bit prudent. As it turns out, we should have loaded up more on cash. I think we're going to touch on some changes momentarily. The big thing we decided to do during the last quarter was to say, let's have a few more bonds. Bond yields, very attractive. The outlook for common equity, more uncertain. Did we get the call on fixed income on those bonds correct? Absolutely. You've seen how yields have come down subsequently. What we didn't predict was just quite how enthused the equity market was going to be about that rally. I see that as a technical. I see that as some investors just really waiting for that signal and then seeking to jump in. I.e., I think this is not a particularly healthy rally. I think it's a rally that's probably got a bit ahead of itself, and so clearly would like to have been overweight equity and to have made even higher returns than the one which we posted. But I think, if I think back to what we knew at the time, what we foresaw, would I make the same decision again? Probably. I don't think it was a poor decision, even if it's cost us a little bit. So those are the two things that didn't work. We should have had less cash. And then in terms of that equity rally, we should have had more of the things that really shot up. And again, it was more in that kind of tech sector, and it was dominated by the US. In terms of changes over the year, if you go right back to the start of 23, we were still finishing that transition from our previous equity implementation to our new blend of managers. As I say, they come through the Momentum Global Equity Strategy, but that's purely a wrapper around what we think are the world's best managers, guys like Giessing, guys like Granahan, guys like Rainier, some of whom you've hopefully heard of or heard me talk about, but who you cannot access otherwise in South Africa. That is why we're using this strategy. That is why it is a key differentiator for these portfolios, because what it's giving you is access to managers that otherwise you wouldn't be able to use in South Africa. Fast forward then to August, and we thought at this point yields are up quite nicely. Let's add a few more bonds, particularly to the cautious profile. Finally then, end of November into December, we added again to those bond positions. Reasonable timing if you think that the US 10-year at that point was around the 4.8% level. It subsequently went right back down through 4%. So during that time, a decent rally, decent returns. So those then are the changes we made. Our asset allocation views bringing us pretty much right up to date, because I can tell you while I'm in January, not much has changed about how we're thinking about the world. Equities, you can see, slightly beneath that par score of 4. Why is that? Well, as I say, equity valuations have moved up. The rally has been driven seemingly by the biggest companies, and the biggest companies exclusively are listed in the US. That looks a little bit unhealthy. So while we by no means hate equities, we have plenty of them, we're not going to be overweight as things stand. Fixed income we like a bit more, up to a neutral score of 4. That's why we've been adding to bonds. Today with that US 10-year in the range of about 4.15%, we're not yet looking to add any more bonds. We'd like to see that drift back a bit. As that yield drifts up, what it's saying is that investors are starting to dial back their expectations of how much the Federal Reserve could cut interest rates in 2024. That would be a healthy development, because in our view, as I say, the likelihood of seeing of the order of 6 quarter-point interest rate cuts in 2024, that is pretty unlikely. The market needs to correct. When it does that, when yields are higher, we may again be looking to add some bonds. And then areas we'd certainly like are alternatives. So that's things like our gold positions. There is still a lot of geopolitical uncertainty out there. And indeed, we like our property positions. So I spoke about equity markets having moved a long way in a short period of time. You can see that here in terms of equity valuations and forward PEs. Note that we're not sat on some kind of spike. I'm not saying equity markets are terrible value. That's why we still own quite a lot of them. But equally, a move like that in a short space of time, it leads us to want to be a little bit cautious in the short term and keep hold of some of our cash, which we're doing. When we think about bonds, the title of this chart really summarizes it. Cash bonds still offering decent real returns, so real returns above inflation. That picture hasn't materially changed, so absolutely we want some of these assets. The whole world of asset classes is currently underpinned by a yield on a 1-year Treasury inflation-protected bond in the United States, a yield of 2.4%. So a real yield in the US over the next 12 months of 2 2.4%. That is your underpinning. That is the minimum you should expect in dollar terms to make from portfolios. That is a very decent underpinning and makes us quite comfortable owning bonds and indeed most asset classes out there. Final slide then from me, and it's the four hexagons. Anyway, the four shapes that we always reference here. Inflation and monetary policy, the key point, as I think you know, is we've reached a turning point. Yes, the world looks much better than it did at the start of 2023. The outlook for inflation is more certain. It's never certain, but it's more certain. We therefore know more about the way interest rates are likely to look. That said, we have moved a long way in terms of where interest rates were, ultra low, to where they are today. In the US, still in excess of 5%. There is a non-negligible chance that we get something break as a result of that big rise in interest rates. So in terms of the economic outlook, we've still got companies that are dealing with that rise in interest rates. That is something to be mindful of this year. And in terms of risks, as I say, it is that risk that something breaks that is still meaningful and we need to pay attention to. Alongside that, geopolitics is going to be important, and even more so this year, given we have a huge number of elections going on around the year. Another reason very comfortable to hold gold. But bring it all together with an underlying return adjusted for inflation of 2.4% on a one-year US Treasury inflation protected security. That is a great underline for investment markets, and that means whilst there will no doubt be bouts of volatility, there always are, we think we should be in for another reasonable year in 2024. And with that, I'll thank and hand over to the next speaker. Thank you.
Thank you, Richard. Just a reminder to please watch the full session and add your ID to the CPD section so we can verify your attendance. You may also view this event on this platform at any time until the end of February and receive your CPD points. Thank you for joining us today. We hope you found this webinar insightful.